Hello, Dr. Ruby Audra. We are Group 20, and today we will present our analysis for British Bureau's annual report. First, let me introduce our team members: 穆一鸣、黄阳业、冯景成、王思彤、吕亚慧、李思琪, and myself, Yang Rong. As a group leader, I will kick for the first section, company background and research methodology. British Beerus is a Malaysia-listed company deeply interested in the environmental energy sector. Adopting a highly vertical integrated business model, its core operational fall into three major segments. One is for environmental products and services, the primary revenue driver for the company. The segment includes water treatment chemicals, laboratory analysis, and environmental consulting service, on which the company builds its marketing operation by virtue of high technical barriers and strong customer loyalty. Two is for the design, installation, and commission for water treatment systems. Three is for investment business, which mainly consists for management service and holding for investment priorities. This report adopts combined quantitative and qualitative research approaches. Based on the company's Attitude 2023 annual report, we conduct hierarchy analysis, vertical analysis, and racial analysis to dig deep into the operation logic behind the data. Next, Mr. Huang Yangye will walk you through the detailed breakdown of the financial data.
Thanks to Yang Rong's introduction. Hi, my name is Huang Yangye and my student number is 24201871. And now I'm going to do the financial analysis about the company financial performance through the year 2022 to 2023. And I'm going to use horizontal analysis and vertical analysis. From this slide, we can see these two tables. Here we use horizontal analysis to compare performance across the years. Revenue dropped slightly, but costs didn't fall accordingly, especially administrative and financing costs. This shows cost pressure is increasing over time. And for these slides from the horizontal analysis, three trends stand out. Administrative expenses keep rising, financing costs increase sharply, while revenue growth is weak. This indicates declining profit quality and growing financial risks. And for the next slides, we are going to use the vertical analysis. This slide applies vertical analysis using total assets as the base. Investment properties make up about 2/3 of total assets, which is very high. This explains the company's low asset efficiency. And for the next slides, based on vertical analysis, the company has a higher equity proportion, around 65%. The interest coverage ratio is still strong, meaning debt risk is controllable. So the structure is safe, but not very efficient. And for these slides, we're combining horizontal and vertical analysis. We see two main problems of the companies. The trends are worsening over time, and asset structure is too conservative, and the company is stable, but efficiency and growth are limited. For more details, let's welcome my classmate Mu Yiming to do the ratio analysis. Thank you.
Thank you, Yang Ye. Based on the background and financial overview just presented, I will now continue with the ratio analysis of British company. First, let me talk about liquidity ratios, which measure the company's short-term repayment ability. The current ratio is 3.89, meaning that for every 1 ringgit of current liabilities, the company has almost 4 ringgit of current assets. The quick ratio, which includes inventory, is still high at 3.77. This shows that the British has very strong short-term solvency and faces almost no risk of short-term go break. However, compared with the industry benchmark, such a high ratio may also indicate inefficient use of funds, especially excess cash that is not fully invested. Next, I will move on the ratios, which reflect long-term financial stability. The company's debt-to-assets ratio is 39.6%, which falls within the industry's healthy range of 30% to 55%. In addition, the invested coverage ratio is 4.74, meaning operating profits can cover invested expansions near 5 times. Overall, this indicates that BlackTech has a reasonable capital structure, manageable financial risk, and a sufficient ability to meet its long-term debt obligations. Finally, let's look at the efficiency ratios. The inventory turnover is 12.97 times per year, which is significantly higher than the industry average. This suggests excellent inventory management and efficient supply chain operations. However, the total asset turnover is only 0.18 times, far below the industry benchmark. This low efficiency is mainly due to the company holding a large proportion of investment properties, which generate real income but do not directly support core business operations. BlackTech demonstrates strong liquidity and profitability, but its analyzation efficiency could be further improved. With that, I will now pass the presentation to Jincheng, who will continue with the next section.
Thank you, Mu Yiming, for your in-depth analysis. Next, I will interpret the company's performance from 3 dimensions. First, a 5-year trend analysis from 2019 to 2023. The company's revenue has shown a L-shaped stagnation trend, dropping from a peak of 27.85 million Malaysian ringgit in 2019 to 25.11 million Malaysian ringgit in 2023. Although there was a slight rebound after the pandemic, the long-term growth has been weak, which may reflect a saturation in the core market or a conservative expansion strategy. However, it is worth noting that the pre-tax profit has remained relatively stable, demonstrating the company's strong cost-passing ability and risk resistance. Second, industry benchmarking. Compared with the manufacturing and distribution industry in Malaysia, the company's core advantages are extremely prominent. A gross profit margin of 59% and an operating profit margin of 43.9%, both several times the industry average. However, the total asset turnover rate of 0.17 times and other indicators of capital utilization efficiency are significant behind. This high profit, low turnover characteristic stems from the company's environmental services plus real estate holding hybrid model. Finally, through SWOT analysis, we summarize the company's strengths lie in high-margin core business, abundant cash flow, and deep technological accumulation. Weaknesses include an imbalanced asset structure, stagnant revenue growth, and high administrative expenses. Opportunities come from the rising demand for ESG compliance in Malaysia, the water treatment automation upgrade brought by Industry 4.0, and the possibility of expansion through mergers and acquisitions. Threats include rising interest rates pushing up finance costs, intensifying operational pressure due to inflation, and fluctuation in real estate market affecting asset valuation. This hybrid model raises a key question. Should the company focus on industrial services or transform into a real estate holding company? The answer will be reviewed in the subsequent strategic recommendations. Next, Wang Sitong will present the core strategies for revenue growth and asset optimization.
Thank you for Jincheng's analysis. In response to the company's core contradictions, we put forward 2 major growth strategies. First, strengthen core business competitiveness of water treatment solutions. Our environmental protection services have a 59% growth margin. We will expand in 3 ways. Firstly, secure more government and industrial contracts by leveraging Malaysia's wastewater treatment policies. Secondly, launch subscription-based digital monitoring services and build a software plus monitoring plus maintenance recurring income model. Thirdly, shift the profit chain from engineering constructions to long-term operation for stable revenue. We expect the compound annual growth rate of core revenue to rise from 0% to 5 to 8%, and the proportion of recurring income to be no less than 15%. Second, revitalize investment real estate to create a second growth curve, aiming at 66.4% low return real estate assets, we will execute the activation, adjustment, optimization three-step strategy. 2025 to 2026. Reassess and renovate inefficient assets into industrial warehouses and SME incubators, lifting retail yield to 4 to 6%. 2027 to 2028. Dispose of 15 to 25% non-core assets to repay loans and fund core business R&D. 2029. Form a high return asset portfolio with target yield 5 to 7% above the industrial average. We anticipate 15% retail revenue growth and asset turnover rising from 0.17 to 0.13 to 0.14. Next, Liahui will share how to protect profit margins through risk management and cost control.
Thanks to Wang Hong for sharing. Risk and cost control are critical for enterprise development, with two major plans proposed. First, administrative and operating expenses control. In 2023, admin expenses rose 15.6%, far outpacing revenue decline. The 5-year goal is to reduce their proportion from 26.36% to 20-22%, saving 15,000 to 18,000 rigid. Cumulatively, measures includes introducing an ERP plus CRM system in 2025 to 2026 to cut cost by 8 to 12% annually, and optimizing the supply chain to lower procurement cost by 3 to 5%. Second, financial cost and debate optimization. Financing cost surged 56.7%. Targets are to reduce the financial cost to pre-tax profit ratio to under 10% and adjust the debate ratio from 17 to 13 ratio to 15 to 15 ratio. Core steps involved repaying high interest loans with idle funds, refinancing for lower rates, and setting a minimum return requirement for borrowing. These measures will block cost bleeding points and ensure profit stability. Next, Li Siqi will supplement and summarize the financing strategy.
Thank you, Liu Yahui, for your sharing. Finally, I will supplement the financing optimization plan and summarize the overall strategy. In terms of financing optimization, the core is to activate internal funds and reduce external dependence. On the one hand, the company's undistributed profits have increased by 15.8%, and the cash flow is abundant. In the future, a financing model of retained earnings priority should be established, focusing on investing profits in core areas such as water treatment technology, research and development, replacing high-cost bank loans and reducing interest expenses from the root. On the other hand, from 2027 to 2029, a comprehensive screening of investment properties should be conducted, disposing of non-core assets that have not met expected returns or have been long-term weakened, and recovering funds to supplement working capital or repay debts, optimizing the financial leverage without increasing equity. Regarding debt structure adjustment, in response to the current problem of a high proportion of long-term loans, it is recommended to refinance and replace high-interest debts during the period of declining interest rates. At the same time, taking advantage of the company's strong short-term debt-paying ability, quick ratio of 3.77, it is advisable to appropriately increase low-cost short-term trade financing to replace part of the long-term capital expenditure and reduce the overall financing cost. In conclusion, BadTech is an invisible champion with strong core business profitability and a solid financial foundation, but the excessive real estate assets have masked its growth potential. Through implementing a light asset transformation, optimizing the asset structure, focusing on high-margin environmental services, strictly controlling cost risks, and optimizing the financing model, the company is expected to transform from a rental plus service hybrid enterprise into a high-growth, high-return pure environmental technology giant. This is all the analysis from our group. Thank you, teachers and classmates, for your attention.